If technical indicators have ever felt confusing, today we simplify them. In this lesson, we break down 3 of the most widely used leading indicators: the Relative Strength Index, RSI, the Stochastic Oscillator, and Fibonacci Retracement, and show you how to apply them with structure and discipline. By the end of this lesson, you won't just recognize these indicators. You'll understand what they measure and how to use them effectively within your own strategy. Let's begin. Here's a quick question. A leading indicator is used to confirm trends after they happen. True or false? Take a moment to think it through. Record your answer. Then we'll get right into today's lesson. The correct answer is false. Leading indicators are not designed to confirm trends after they happen. That's the role of lagging indicators. Leading indicators signal potential shifts before price fully confirms. To further clarify, leading indicators are used to anticipate potential price movement before a trend begins. They attempt to signal early shifts in momentum before the market fully confirms direction. Their purpose is not to confirm what already happened. They are designed to help us anticipate what might happen next. That distinction separates reactive trading from prepared trading. What exactly are they measuring? Leading indicators measure how the market is moving. Their primary focus is momentum, the strength and speed behind a price move. When price moves fast and with force, momentum is building. When price begins to slow, momentum is weakening. And when momentum starts to fade, it can signal that the current trend may be running out of steam. Momentum doesn't tell us everything, but it does tell us when market strength is shifting. When momentum is rising, it's often a sign to ride the trend. We enter trades in the direction of the move and remain in position as long as momentum continues to build. But when momentum begins to slow, conditions are changing. It may be time to prepare for a possible reversal or tighten your stop loss to protect existing profits. By watching momentum closely, we improve our entries, manage our exits with discipline, and avoid getting trapped in weakening trends. Knowledge check. You are observing a bullish market with 3 potential entry opportunities: Phase A, Phase B, and Phase C. Each phase reflects a different level of momentum behind the move. Your objective is not to enter too early or too late, but to identify the safest and most efficient entry based on momentum strength. Where would you enter? Phase A, Phase B, or Phase C? You have 10 seconds to record your answer. The correct answer is Phase B. Phase A may be too early. Momentum is beginning to build, but it hasn't fully developed. Entering there increases the risk of being stopped out early. Phase C may be too late. Momentum could already be fading, and price action may become unstable or overextended. Phase B represents the balance point. Momentum is strong, and price action is more stable. That's the sweet spot. Strength with structure. Another key element leading indicators focus on is market pressure, the ongoing tug-of-war between buyers and sellers. When buyers have the upper hand, prices tend to move higher as demand pushes the market upward. When sellers gain control, prices often begin to fall as supply outweighs demand. Understanding who is applying the most pressure helps us interpret momentum with greater clarity. Leading indicators help detect shifts in market pressure before price fully reacts. By identifying changes in buying or selling pressure early, we have more time to make disciplined decisions. This allows us to prepare for potential reversals, breakouts, or breakdowns with stronger timing and better risk control. Early awareness doesn't guarantee outcome, but it does improve our execution. Let's test your understanding of market pressure. Recognizing whether buyers, sellers, or neither side is in control helps guide your next move as a trader. Your task is to match each market pressure condition with the most appropriate action. Read each option carefully and select the response that reflects who is currently in control, buyers or sellers. On the left, you have three market conditions. A. Buyers and sellers are balanced. B. Buyers are in control. C. Sellers are in control. On the right, you have three possible actions. D. Look for long opportunities. E. Wait for clearer direction. F. Avoid long positions and consider short setups. Match each market condition with the most appropriate trading response. You have 10 seconds to record your answers. Let's reveal the correct matches. A. Buyers and sellers balanced. Matches with E. Wait for direction. B. Buyers in control. Matches with D. Look for buying opportunities. C. Sellers in control. Matches with F. Avoid long positions and consider short setups. Trading decisions should reflect who is in control, not personal bias. Tracking momentum and market pressure may sound complex, but you don't have to calculate it manually. Leading indicators automatically analyze these shifts for you. That allows us to spend less time guessing and more time making smart, disciplined trading decisions. Now let's explore three of the most common leading indicators. The first is the Relative Strength Index, or RSI. RSI measures the strength of recent price movements and helps determine whether an asset may be overbought, meaning price has moved too high too quickly, or oversold, meaning price may have fallen too far, too fast. It gives us insight into momentum conditions before price fully reacts. The RSI gives you a number between 0 and 100. A stock is generally considered overbought when the RSI rises above 70. It is considered oversold when the RSI falls below 30. When the RSI approaches 30, many traders begin looking for buying opportunities. At that level, the stock may be oversold and could be preparing for a bounce. When the RSI approaches 70, traders often look to sell or take profits. At that level, the stock may be overbought and due for a pullback. At its core, trading comes down to one timeless principle: buy low, sell high. Let's do another knowledge check. An RSI reading of 72 may be a signal to consider buying an asset. Is this statement true or false? Think it through carefully. Take a moment to record your answer. This statement is false. An RSI reading of 72 places the stock in the overbought zone. When the RSI is above 70, traders typically avoid entering buying positions. Rather, they look to take profits or consider entering short opportunities. Buying above 70 increases your risk of entering a losing trade. Now let's move on to the next popular leading indicator, the Stochastic Oscillator. The Stochastic Oscillator compares the current price to its recent trading range. By doing this, it helps traders identify shifts in momentum. In simple terms, the Stochastic Oscillator displays whether the market may be losing strength or preparing for a potential market turn. The Stochastic Oscillator displays two lines that move between 0 and 100. The first line, called %K, reflects current momentum based on recent price action. The second line, called %D, is a smooth version of %K. It helps confirm potential signals by reducing short-term noise. When the %K line crosses above the %D line from below the 20 level, many traders view it as a potential buy signal. At that level, the market may be considered oversold, and the crossover can suggest that momentum is beginning to shift upward. When the %K line crosses below the %D line from above the 80 level, it is often viewed as a potential sell signal. In that case, the market may be considered overbought, and momentum could be turning downward. The crossover itself does not guarantee a trade. It simply helps traders evaluate whether a change in momentum may be strong enough to consider action. Let's apply what we've learned about the stochastic oscillator. On the left, you have three stochastic behaviors. A, the %K line crosses above the %D line below the 20 level. B, the %K line crosses below the %D line above the 80 level. C, both lines are moving sideways near the 50 level. On the right, you have three possible interpretations. D, potential bullish signal. E, potential bearish signal. F, no clear momentum edge. Match each behavior with the most appropriate trading meaning. You have 10 seconds to record your answers. Let's reveal the correct matches. A, matches with D. When %K crosses above %D below the 20 level, it signals potential bullish momentum. B matches with E. When %K crosses below %D above the 80 level, it signals potential bearish momentum. And C matches with F. When both lines move sideways near the midpoint, there is no clear momentum advantage. As always, the goal is alignment. We act when momentum supports the direction, and wait when it does not. Now let's explore our final leading indicator in this lesson, the Fibonacci retracement. This is one of Professor Jeff's favorite tools. Fibonacci retracement helps traders identify potential pullback zones within a trend. These are areas where price may pause, retrace, or reverse before continuing in the original direction. It provides structure and clarity during temporary pullbacks inside a larger move. To apply Fibonacci retracement, traders first identify a significant price movement, either upward or downward. The Fibonacci tool is then applied from the start of that move to the end of that move. Once applied, the tool automatically plots horizontal levels at key Fibonacci ratios: 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels help identify potential pullback zones within the larger trend. Traders often treat Fibonacci levels as key decision zones during a pullback. When price reaches the 38.2% level, it is considered a shallow retracement. This typically suggests the trend remains strong, and many traders begin looking for early opportunities to rejoin the move in the direction of the trend. The 50% level, while not an official Fibonacci ratio, is widely recognized as a common pause point during a pullback. Price often reacts around this level. Because of that, traders typically wait for confirmation before entering or adding to a position. The 61.8% level, known as the golden ratio, is one of the most closely watched Fibonacci levels. It is often viewed as a strong potential reversal zone during a pullback. At this level, traders may consider entering positions, placing stop losses, or taking profits, depending on their overall strategy and market structure. Every effective Fibonacci setup begins with a structured process. Review the steps below and arrange them in the correct order to identify key retracement levels and plan your trade with clarity and discipline. Now, let's arrange the steps in the proper sequence. A, draw the Fibonacci retracement. B, watch price at key levels. C, identify the trend. D, find the high and low. Place them in the correct order to build a disciplined Fibonacci setup. You have 10 seconds to record your answer. Let's reveal the correct order. First, C, identify the trend. Second, D, find the high and the low of that move. Third, A, draw the Fibonacci retracement from the start of the move to the end. Finally, B, watch how price reacts at the key retracement levels. Structure first, execution second. That's how Fibonacci is used with discipline. Lesson complete. Today you learned what leading indicators are and how they help anticipate potential shifts in momentum and market pressure. We explored 3 powerful tools: the Relative Strength Index, the Stochastic Oscillator, and Fibonacci Retracement. Each one serves a different purpose. RSI helps identify overbought and oversold conditions. The Stochastic Oscillator highlights momentum crossovers. Fibonacci Retracement helps locate structured pullback zones within a trend. Remember, leading indicators are not crystal balls. They provide probabilities, not guarantees. Strong work. We've now completed Day 15, Lesson 2. Solid progress. Keep leveling up. The more you practice applying these concepts, the more effective and confident you'll become in real market conditions. Understanding ideas is one thing. Applying them consistently is what builds skill. This is why simulators matter. They allow you to practice, make mistakes, and refine your process without risking real capital. See you in the next lesson.
Ready to master trading psychology? Visit marketmindsetuniversity.com, where you'll get free access to Day 0 course videos and see how we teach trading the right way, step by step, with structure and clarity. Practice with purpose and perform with precision. I'm Michelle, and we'll see you in the next lesson.